What if the modern economy wasn't actually born from careful innovation or a handshake, but from a heist? A heist that history has tried very, very hard to forget. Welcome to This Explainer. Today, we're diving into a story that is going to completely change how you look at the money in your pocket. We're unpacking our source material to reveal a pretty startling premise. We're heading back to the Roaring '20s, a time of unprecedented wealth, to dig into a suppressed scandal that quietly laid the tracks for our entire modern financial system. Let's get into it. Now, this is a highly contrarian blueprint. The sources argue that the incredibly complex financial web we live in today wasn't organic economic growth at all. Actually, it was a fraudulent ledger that birthed the absolute ruthless mechanics of modern central banking. The wealth that people thought they saw back then, largely an illusion, masking a systemic weaponization of debt that was happening entirely behind closed doors. So it really forces us to ask, is the global financial system an evolution, or is it a crime scene? The material we're looking at argues that a specific, highly secretive banking scandal in 1926 finalized a blueprint of institutionalized deception. And honestly, the wildest part is that this very blueprint still dictates global liquidity right now in our current year of 2026. We are literally looking at the possibility that the foundation of global finance was laid by a single, colossal act of fraud. Which brings us to Section 1, the Ghost Ledger. Our sources starkly contrast two very different realities from that era. You see, the public was totally distracted by the opulence of the Jazz Age, right? The endless champagne, the booming stock market, just pure economic euphoria. But hidden away was this terrifying insolvency infecting the era's most trusted financial institutions. They were keeping what the sources called ghost ledgers, books that looked perfectly balanced on paper but were in reality entirely hollowed out by systemic debt. The pivotal moment for all of this arrived in 1924 with a specific, massive accounting breach. Through some incredibly deceptive ledger practices, a single firm managed to wildly inflate their assets by 400%. And we're talking literally overnight. I mean, imagine waking up and your bank just magically deciding they have 4 times the money they actually hold, using absolutely nothing but creative accounting. That is exactly what happened here. And because this localized fraud went entirely undetected by the regulators of the era, it didn't just stay local. It spread like a virus. It set the stage for a massive national contagion of invisible debt. Suddenly, major institutions were borrowing heavily against assets that simply did not exist. So, how did they pull it off? Let's move to Section 2, Anatomy of a Systemic Heist. The architects of this scandal utilized what the sources refer to as a circular credit loop. First, they would create fake deposits on the ledger. Next, they'd loop those phantom funds right back to their own firm as loans or investments. Step by step, they were manufacturing liquidity completely out of thin air. It was essentially printing money on paper without actually printing a single physical dollar bill. Now, if this sounds familiar to you, well, it absolutely should. According to the text, this 1920s circular loop is the direct ancestor of modern fractional reserve lending. You know, the banking practice, where your bank only holds a tiny fraction of its deposit liabilities while lending out the rest. The sources frame our modern digital asset creation and lending practices as just the modern equivalent of that original 1920s deception. Of course, a house of cards that huge eventually teeters. But instead of facing justice when the system began to wobble, the scandal's architects pulled a completely different lever. The sources reveal they held secret, closed-door meetings with powerful political figures. Their main goal? To desperately prevent a public bank run that would expose their empty vaults to the world. They absolutely needed the government's help to cover the whole thing up. And that cover-up is what we're looking at in Section 3, the birth of institutional immunity. Following the timeline here reveals a pretty shocking evolution. We start with that 1924 accounting breach. By 1926, the secret political meetings are well underway. And then comes the real turning point in the late 1920s. Regulators actually chose to subsidize the fraud rather than prosecute the perpetrators. They decided that letting these massive institutions fail would just be too devastating to the public economy. And this triggered a massive legislative shift into the 1930s and beyond, which fundamentally transformed private banking losses into permanent public liabilities. When the banks gambled and lost, the taxpayer was suddenly on the hook. This exact precedent gave birth to a phrase I'm sure you hear constantly: too big to fail. This doctrine dictates that certain institutions are so vital to the economy that the government absolutely must bail them out, no matter what. And according to our source material, this entire concept was born directly from that 1920s cover-up, and it heavily governs our current 2026 financial landscape. Let's look at how this grew into what we have today in Section 4, Mechanizing Global Liquidity. Over the decades, these exact tactics simply received a technological upgrade. The paper fraud, the circular credit loops, and that local contagion of the 1920s, they didn't disappear. The sources argue they evolved into the sophisticated algorithms, digital asset creation, and global liquidity control mechanisms used by central banks today. The tools changed, for sure, but the underlying architecture of creating liquidity out of debt remained exactly the same. To maintain this complex system, a massive transition had to occur. Global finance had to move away from the rigid stability of being backed by gold. In its place, a totally new system that the text argues is actively fueled by a perpetual cycle of manufactured crises. By constantly managing these rolling crises, the institutions maintain absolute control over the flow of money. The end result is what the text emphatically calls weaponized debt, the primary tool for controlling international currency values. By turning debt into a literal weapon, the financial descendants of this 1920 scandal secured the ultimate tool to manipulate markets. They can now control international currency values on a global scale, shifting the economic fate of entire nations with just a few keystrokes. Bringing it all together in our final section, the blueprint for modern control. The source material makes a very clear case here. The direct link between that 1920 scandal and your life today is exposed through the massive centralization of global wealth. The invisible fingerprints of that original heist are literally everywhere. You can see them in the dominance of high-frequency trading, which manipulates tiny fractions of pennies millions of times a second. You can see them in modern sovereign debt structures, which are built on the exact same perpetual looping of credit that was invented a century ago. The wealth isn't trickling down, folks. It is being systematically looped upward. Which leaves us with a pretty critical thought to end on. The sources suggest that successfully navigating the impending 2027 fiscal shifts requires a really deep understanding of these origins. Because if the very foundation of our liquidity is built on a century-old ghost ledger, how safe are your assets truly today? It's a question you simply can't afford to ignore as we head into the next financial era. Thanks for joining me on this explainer. Keep questioning what's behind the numbers.